Okay, we've been promising you a big voice also on the markets at 9:40 a.m. and here he is, Marc Faber, the editor and publisher of the Gloom, Boom and Doom report. Marc Faber, welcome back to ET Now. It's always a pleasure talking to you. My first question to you has to be on what we are seeing, that war between Russia and Ukraine, the effect that it's had on the energy market, the new oil shock that we're all seeing, and the effect on the equity markets. Let's start this interview with your opening comments on that big global trigger.
Well, thank you for having me on your program. I think the recent decline has been expected by numerous observers because the economy in the US is not doing particularly well. We have artificially low interest rates in Europe and in the US and in most other countries. When you consider in the US, we have a rate of inflation of, say, between 6% and 12%, depending on the person, depending on the household. And the Federal Reserve is still discussing whether to increase interest rates by 1/4 or 0.5%. And this situation with the inflation where it is, in the 70s, when that occurred, such high inflation rates, we had a Fed fund rate of over 8%. So it shows there's a disconnect between the Federal Reserve and the real economy. And then we have these geopolitical problems. And in every speech I've been giving in the last few years, I said, in investments, the one proviso for success at the present time of relatively high valuations is peace in the world. And this peace in the world is now no longer guaranteed. A journalist who is well known in the UK said this conflict in the Ukraine is the most useless conflict we ever had. There's no reason on either side to go to war. And this would be essentially my opinion, that this war is not about freedom of the Ukrainian people or anything, but it's a design by some neocons in the US and some people that are interested in war, and a Russia that is more belligerent and doesn't like this NATO expansion, period. So anyway, this conflict has now been used as an excuse to knock down markets, which were, as I explained before, essentially stretched, overvalued, and vulnerable to a setback because of tightening monetary conditions.
And when was the last time that we saw a war which was not senseless, but Marc Faber, whichever way it is raging, right? And we are seeing the impact that's happening on the markets. Now, each side, with it's Moscow saying we'll cut off gas supply to Europe, America saying we'll take the Russian and oil out of the global energy mix. I would imagine, and you tell us, is this conflict, this war, that's really on top of investors' minds? So till we have clarity on that, what we're seeing in the markets, that's going to continue?
Well, the damage to markets has been done unevenly. If you own Russian stocks, they're worth next to nothing at the present time. Will they ever be worse again? Anything, who knows? But collectively, if you look at European markets, they're all down 10, 15% this year alone. So the damage has been very considerable. The only sector that I can say which has really benefited from all this, but it's not good economically, especially not for the poor people, is the commodities sector, the agricultural sector, and oil, and of course, more recently precious metals, which have performed well, and precious metal stocks. So if you were in precious metals, and I've always argued for the last 30 years, you need to own some gold, silver, platinum as an insurance against the political problems, against turbulence, against chaos in the world. If you own that, you are partially hedged. But if you only own 5% of your assets in gold and 95% of your assets in stocks, the hedge was too small. You understand? So only people who had a meaningful position in oil and gold have kind of offset the losses they had elsewhere.
Sure, Mark, since you did mention about oil, I wanted to understand whether you see that what's playing out right now is at best a knee-jerk reaction, or do you think oil prices, or for that matter, the entire energy basket is going to remain at elevated levels?
I think that oil prices were in a rising trend because of the environmentalists that, like Biden, the first day in office, he shut down the Keystone pipeline. Now he's begging Saudi Arabia and Venezuela and Iran to supply more oil. I mean, sometimes as an independent observer, without sympathy for the Americans or less sympathies, but somewhere you have to say the American policymakers are brain damaged. They pursue policies that are contrary to their interests. And also the ESG crowd in Europe, the Greens, the so-called environmentalist extremes, they are actually socialists and not so green, but that's a different subject. They insisted on closing down nuclear power plants. Now you have to consider this. You close down nuclear power plants and you pursue energy policies that actually demand more energy. And where do you get that energy from? From Russia. So the oil price, in my opinion, because of all these green technologies, and I mean, people don't realize that if you have an electric car, you need electricity to power it on in order to recharge the battery. But the electricity is generated with natural gas, with coal, with oil, with solar and wind power. But wind power is very inefficient as a source of energy. To build a windmill is about the most energy or environmentally healthy and desirable kind of investment. The best is nuclear, but that they don't want.
Sure. Mark, but the other thing also is whether oil prices being at these elevated levels makes other commodities or greener fuels for that matter more attractive and gives way for greener fuels to come in and perhaps be swiftly adapted to.
Yes, I am suggesting that the whole shift, if you really want to have clean energy, and I have seen studies that are very detailed, I can tell you that if you if you convert all the cars in the world to batteries tomorrow, it may have a horrible environmental negative impact. A really negative impact of incredible dimensions, because you need lithium, you need all kinds of rare earths material, you need copper and so forth, and certain parts of that battery cannot be recycled. This is another story. You know, when 1 billion Indian will turn up with the used batteries, the recycling will be a disaster. So I tell you, I am all in favor of, we have to try the best for our environment. You know, we shouldn't throw plastic bags along the streets and so forth. And we should try to be clean and friendly towards the environment. And then that there's no question about it. But everything has to make some kind of economic sense in terms of cost and in terms of efficiency. The best, as I said, is nuclear and energy, but that the environmentalists they don't want.
Mark, but it's not only about oil. Agri commodities as well have shot up quite smartly. Do you think, the inflation is led by oil and not by others, and that is going to continue to remain elevated?
Yes. And sadly, and here I have to make a social observation, because I live as a dual personality. On the one hand, I'm an investor. So if the Fed prints money, I could applaud it and say, yeah, my asset values go up in value, my real estate, my gold portfolio, my stock portfolio, and so forth. But as a social observer, I have to say the monetary policies have been a disaster. And they are boosting now the rate of inflation. And I would here say we can measure inflation in different ways, but the probably best way to measure the impact on ordinary people is to look at the price of necessities, okay? Necessities are food, energy, shelter, rents, and so forth. So these prices right now in the Western world are going up much more than wage increases. And that will create, in real terms, inflation adjusted. So let's say if prices go up 10% per annum, this year we have an index of 100, next year is 110. And my wage goes up by 3 or 4%, then in a year's time, I am 6 or 7% or 5% poorer in terms of income. And this is squeezing now the lower classes. It's like the war in Ukraine is decided by people who sit in a comfortable chair in front of TVs watching football games, and the people on the ground in Ukraine suffer. This is what modern warfare is like.
Right.
At
Strong words of
in the old times, the Indian kings, the Maharajas and so forth, they were leading their armies.
Mark, it seems like the markets have really forgotten about the rate hikes. That was one of the biggest talking points in the month of January. Do you think that hyperinflation will now lead to talks about rate hikes yet again on Wall Street?
I have argued for the last 1 year. COVID is bad, but just wait until it's over. Then they'll invent something else to intervene into the economy and to distract the attention. You see, my theory, and people will say, well, it's a conspiracy. My theory is in 2018, 2019, the economy began to slow down. So they had to print money, but massively. And COVID was a very good excuse to print massive amount of money, to get rid of Trump, and also to increase fiscal spending massively. Fiscal spending expansion and money printing is one of the best recipes for inflation, that for sure. Anyway, that's what they've done. Now, after 2 years of COVID BS, the public got tired of this COVID, and there are so many studies coming out that essentially raise a lot of questions about the origin and the so forth and the policies. So they got rid of COVID. In other words, Putin got rid of COVID, and now they have the Ukraine war. And that distracts the attention from the failure of domestic policies in the US. We shouldn't forget that.
Marc Faber, we have so much more to talk to you about, but we have to take a scheduled sponsored commercial break. It's just 1 minute long. Stay with us, viewers, stay with us. We'll be back with Marc Faber. Right, welcome back. We remain in conversation with Marc Faber, one of the most authoritative voices that you'll have to help you understand and navigate the markets that we have seen. Okay, we've talked about commodities, we've talked about the war, Marc Faber, but now let's talk about what's happening in the US equity markets as well as the emerging markets. As investor press the sell button, what are you doing? Would you say that American stocks or EMs via an ETF basket is an attractive option? Or are you doing what many others are talking about, the super cycle of commodities, and this is the time to be in the commodities market?
Well, nothing will be the same. The leadership of the US since 2009, especially after 2015 vis-a-vis other markets, has never been before so wide. In other words, the US soaring and other markets essentially moving sideways or down. So if you look at the valuation difference between the US market and Europe, the US and the emerging markets and Europe have never been this cheap compared to the US. And my view would be, and since you're from India, let me tell you, my view would be, if I were told the conflict is solved tomorrow, I would buy Indian shares and not US stocks.
I'm not getting program audio.
Mark, what I also wanted to understand is, you just said that, if indeed the war stops, you're going to buy India as opposed to even US equities. What makes you that bullish in India? Could you tell us what has changed in India for you over the last few years for you to have that kind of conviction?
I mean, it's surprising that in India, so many people are critical of Modi. And overseas, investors and say observer of the Indian social conditions and the economy and political conditions, they all applaud Modi. I think he's been the best that could have happened after the horrendous Gandhi dynasty. This is my view as an investor and as a social observer. The country is in a much better shape than 8 years ago, 10 years ago, much better shape.
Sure. Mark, lastly, wanted to understand where is it that you stand when it comes to value versus growth debate, because recently it's value investment which has been winning.
Well, growth has been outperforming value for the last 10 years or so, but massively. Value compared to growth has never been this low. And this is regarding your first question at the beginning, what to do with commodities. Commodities have gone up a lot, but inflation adjusted and compared to, say, US stocks, they're still very, very low. If you look at the weighting of energy within the S&P, it's very low. That's why I am hesitating to say, well, after the conflict is solved, and after the conflict is solved, is a very big question mark because it may never be solved. It may be kind of a Afghanistan for the next 10 years or so, who knows? We don't know, you understand? I'm not predicting and saying this is good and this is bad. I'm just observing it could last a long time because there's so many very difficult elements involved in Ukraine. It's not just Ukraine, Russia, there are many other elements. Anyway, my view is you should be in value. I think the next big upward move in the market or move in the market, even if it's a down move in the market, is that value will outperform growth.
Value will outperform growth. That's all the time we have for you today, Marc Faber. Thank you so much for joining us and helping us understand how to make sense of all those big global cues at play, which are impacting the Indian markets, and of course the commodity markets, from Brent to nickel to agri commodities like wheat. There's only one way they're going up, and that is up and beating and making new all-time highs. Thank you so much.